this week, we're going to move to my favorite method of startup valuation, which, not surprisingly, it's called the VC method, venture capital method. It is unlike the other methods that we learned about in the previous class. This VC method is developed specifically to value startup companies. So it's not a general purpose valuation method that we're trying to adapt to value startups. It's a method of valuing companies specifically designed for startups, and it therefore doesn't suffer from some of the drawbacks of the other methods that we talked about. Specifically, it values a startup from the perspective of the venture capital investor, taking into account that the venture capital investor is looking to generate a return in the startup through capital appreciation, not through a combination of capital appreciation and dividends. And therefore, I think it gives the most direct approach to valuing a startup, and it gives the startup valuation that directly corresponds to what investors are looking for in the startup. It's also pretty easy to understand and also easy to model and easy to explain how you arrived at the numbers for both sides. So we'll jump into VC method evaluation. We'll also tonight talk about dilution and exit valuation, which are both important aspects of the VC method evaluation. We'll take a look at first we'll look at the overview of these, and then we'll look at how these are reflected in our financial model that we've been using for demonstrations in the previous two classes. Okay, so VC method evaluation. This is how VC method evaluation works. And it's quite straightforward. I mentioned in the early class, I think in the first class, that exit valuation determines current valuation. And I gave a simple, simplified version of VC return formula where I said, we can calculate the VC's return by just dividing the exit valuation by the current valuation. And I think I mentioned at that time that I was leaving out one important detail. At that time, at that point, it didn't matter because we're just trying to understand the concept. But now that we want to understand how to really calculate the valuation using this approach, we'll flesh out that formula and see how we get real VC method valuation. So VC return equals exit valuation divided by current valuation. And at the seed stage, which is where we focus, and that's why I'm going to use that for all of our examples, the VC's required return on investment is 30x, meaning for every dollar invested, the VC needs to get back $30. Now, this might suggest that you could get the current valuation for your startup just by dividing exit valuation by 30, because if VC return equals exit valuation divided by current valuation, and we know that VC return equals 30, then we can just divide exit valuation by current valuation, or divide exit valuation by 30 to get current valuation. But it's not correct, because why? If we use that formula, that formula would be true if the VC's stake at exit was the same as their stake when they invested, meaning that simple formula of dividing exit valuation by current valuation to calculate return assumes no change in the investor's equity. And this is not what's likely to happen, especially since we're looking at seed stage. So it's highly likely that VCs who invest in the seed stage will see their equity diluted by, I estimate, around 50% by exit, which means that, therefore, to apply the VC method valuation, we need to divide the exit valuation by 60 instead of by 30. Because why? We could divide by 30 if equity at exit was 100% of equity at investment, but it won't be. It'll be 50%. So that means instead of dividing by 30, we have to double that number and make it 60. The other way to think about it is 30 times 50%, 60 times 50% would equal 30. So to get to the final calculation, using the VC method at seed stage, current valuation equals exit valuation divided by 60. And this makes it very easy to value your company, because in order to do an effective VC method valuation, since we know we take this 30x as fixed, so all we need to do is calculate the exit valuation and then dilution, and then divide exit valuation by 30 adjusted for dilution. And because we're going to assume dilution is 50%, it becomes even easier, because now we just need to calculate only exit valuation. So as soon as we know exit valuation or projected exit valuation, we can get the current valuation. This is the way that I always think about the current valuation. When startups present their valuation in our first discussion, I always ask about the exit valuation. And if the current valuation is exit valuation divided by 60, then that's great. And then I would be quite happy with that valuation. But if the current valuation is such that it's not what's implied by exit valuation divided by 60, then we need to talk about that, because that means that either current valuation is wrong or exit valuation is wrong. So we need to adjust one of those two. Now, if you are looking at this formula, the questions you probably form immediately are, where do we get the 30x? Because 30x is obviously the key to this calculation. And I can't just make up 30x, just like I couldn't make up discount rate when we talked about DCF valuation. So, and I think a lot of times when, especially entrepreneurs, first encounter this number, they're shocked. Like, how could VC require 30x return per successful investment? It's absurd, and the number is so huge. But in fact, this is the real required return for seed stage venture capital investment. How can we figure that out? So if we start from what is the VC's cost of capital? So here we're 30x in effect is the company's cost of capital for the VC investment. But VCs also have a cost of capital, because VCs are not typically investing their own money, or mostly not investing their own money. They're mostly investing investors' money, the people who put money in their fund. So the VC's cost of capital is the required return that the VC needs to deliver to their investors. And to get to our 30x number, I use 20% as a good estimate of VC's cost of capital, which is actually a little low, because probably 25% or even 30% is closer to really the VC investors' required return, meaning the investors in the VC's funds. But if that's the case, it's going to be current valuation will be even lower. So this is using 20%. It's kinder to the startup. So if the VC needs to deliver 20% IRR, meaning annual return over 10 years, which is the typical lifetime of a venture capital fund, this means that the investors in the VC fund are expecting 6x gross multiple on their fund, on the funds invested. So at this point, you might wonder, wait, if the VC needs to deliver 6x, then why did they need 30x per successful investment? Shouldn't it be current valuation equals exit valuation divided by 6? But it's not, because why? because this 6x needs to be delivered by only 20% of the VC's investments, which will actually exit, or which will actually exit at more than 1x. So something like 75% of venture capital fund investments will return either 0 or less than 1x. And this means that about 20% of the VC's portfolio needs to deliver 100% of its returns. And so we're only working with 20% of the portfolio to deliver this 6x. In order for 20% of the portfolio to grow the portfolio value to 600%, this means that this 20% must increase by 30 times post-dilution. So let's see what that looks like visually. Here you can see this is the initial money in the fund. And this is the required return by fund investors. So if 100% of investments would exit, then we could we could make our required return by just earning 6x on each successful investment. But in fact, what happens is only 20% of the investments actually succeed. So in order for 20% of the investments to deliver 6x on the original fund, each successful investment needs to deliver 30x. So what about some of the other numbers in the venture capital method? So where does my 20% come from? This is because investors in VC funds are the ones that set the cost of VC capital, meaning investors in VC funds require certain levels of investment. And if the VC is not delivering those levels of investment, they won't be able to raise their next fund. So if the VC doesn't deliver this 20% return in fund 1, there'll be no fund 2. And therefore, over time, we're only going to find the vast majority of VCs in the market have to deliver the same cost of capital. VC portfolio returns are not normally distributed. They're not like typical investment fund portfolios where we can look at the mean return and then we can take the standard deviation of returns, and if we graph those across the portfolio, we'll see something like a bell shape. We won't see that for venture capital fund portfolios. What we see is a very small percentage of the investment portfolio drives all of the return. And that happens because most VC invested startups fail to return capital. And this has a consequence for those successful companies, which is the small number of winners must pay for all the losers. My dilution factor comes from the reality that successful startups have to raise many rounds of funding. And when they do that, the investors in the earlier rounds will be diluted. So there's just no way to get to these large exits, or there's no way to get, or very difficult to get to significant exits without companies raising multiple rounds of funding, which will dilute early investors or earlier investors. So this is a graph that shows over a more than a 30-year period what were VC returns to VC investors. And the average or mean cost of capital for the VC was 16% per year. And for the top 25% of VCs, their investors receive 25% return per year on average. And this is net return. So this is after fees, expenses, and carried interest, which means that the gross return, which we were talking about before, needs to be even higher than 30x in order for the fund to deliver 25% per year on a net return basis. And you can see that depending on when these returns are delivered, this requires a more 4 to 6x gross multiple. So these figures are available to venture fund investors. So they're going to continue to require this type of return from the managers that they invest in. This is what I was talking about earlier. The normal distribution is what typical investment portfolio distributions look like. So if we invest in a nicely diversified portfolio of publicly traded companies, we would see most companies would deliver close to the average return. The vast majority of companies, or 2/3 of the companies, would be within one standard deviation plus or minus the mean return, and 95% of the portfolio would be plus or minus 2 standard deviations of the mean return. Venture fund results, portfolio distributions look like this. A very small number of the investments deliver very high returns, and everybody else pretty much contributes nothing or very little. So this is a very important graph to remember when you're thinking about the difference between venture capital fund returns and regular traditional fund returns. And this distribution affects everything about VC fund economics, and most especially the valuation of company in the portfolio. Because if you think about it, if my successful companies don't generate this 30x return, then there's no hope of the fund delivering its required return to investors, because most of the companies are going to deliver zero. This is a real distribution of returns, and you can see it's similar shape. It's showing something a little different though. What we're seeing here is how many, this is the curve backwards. So you see almost 50% of even first non-seed stage investments are delivering zero. And when we get to 20x or more, you can see the tiny, tiny number of investments that are generating those returns. And you can see everything to the left here is 0 or less than 1x. So you can see the same shape as we looked at in the previous graph, looking at real portfolio returns. And this is the same information, but shown just for first non-seed investment and in a pie chart. So you can get a very clear view of 49% of the investments in the first non-seed round are delivering zero, meaning total loss. 25% are delivering less than 1 time. So 74% are not returning even the amount that was invested. And in reality, a lot of this 25%, which is less than 1 time, can be very close to zero. We've seen some investments in our portfolio deliver, let's say on a $300,000 investment, 10 million Thai baht investment. Let's say you get back, if you get back $2,000, so you get back 60,000 Thai baht. It's less than 1 time. It's not zero, but for practical intents and purpose, it's very close to zero. So I usually will say, we'll think about this 75% as effectively zero. And then you have another big slice, 1 to 5x, which is well below the 30x we need to drive all of our overall returns. And then the group that's delivering greater than 20x is only 3%. So that's in most venture capital funds, that'll be 1, 2, or 3 investments that will drive almost all of the returns. And this is showing that even over the next several rounds, we still see a lot of failures. So there is a very high percentage of companies, even through Series B investment, that are failing to deliver any returns. Now, I mentioned that in addition to the required return, the 30x, the other key number in our venture capital method is our dilution assumption. And I mentioned that I was using 50% as an average amount of dilution to be expected by a seed stage company prior to a seed stage investor prior to the exit of that company. And you might think that's very high and wonder where does that come from. But this is an illustration of how that works. So in this case, let's assume that the seed investor got 20% when they came in, which is not unrealistic. And let's assume, now we'll assume further that this startup did 4 rounds of investment after seed. So they did A, B, C, and D, and then they exited. Again, this is not unusual. Some startups will do fewer rounds. So there might be some startups do a exit after the Series A or exit after Series B. But some startups may do many more than 4 rounds. They might do E, F round, they might do G rounds. So I think it's pretty conservative and reasonable to assume 4 funding rounds post-seed. And in this case, we assume that in each subsequent round, new investors take 15%, which again, I think that's a fairly conservative assumption. Some companies that raise 4 subsequent rounds might give up less equity. Some might give up a lot more. So I think 4 rounds, average 15% equity per round. It's a fair assumption for both sides. And where does that leave us? That leaves us with the seed investor at exit holding 10.4%, which is almost exactly 50% of their initial holding. So this is how you see seed stage investors getting diluted by 50%. Now, you can also see, though, the Series D investor wouldn't get diluted at all because they're the last round before exit. So their VC method valuation would just be equal to their exit valuation divided by their required return, and then no adjustment for dilution. And then Series C only have to adjust by 15% because they're only going to be diluted one time by 15%. So this is how, this is why later rounds can have higher valuation. And this is an example of how dilution works. Now, sometimes when we talk about dilution, sometimes entrepreneurs think dilution is bad. And some less sophisticated investors might even think dilution is bad. Might look from the previous pie chart like dilution is bad, but actually dilution is not bad. Dilution is good because if there's no dilution, this means the startup didn't raise any more funding after your round. And in most cases, when the startup doesn't raise any more funding after your round, it means the startup didn't make it. Or best case is, almost best case is, if the startup didn't raise any more funding after your round, then if they didn't die, they didn't grow very big, because it's the funding that the startup raises in each funding round that enables it to grow big. And this is why we can't avoid, and we shouldn't try to avoid dilution. What we want to do is avoid excess dilution. So there is reasonable dilution and excess dilution. Excess dilution is normally means that the company experienced a down round, meaning that in a subsequent funding round, the startup sold shares at a lower price than they did in the previous round. That's called excessive dilution. Normal dilution, where every round the startup sells shares at a higher price than they did in the previous round, is designed into the multi-stage equity fundraising process that startups and venture capital investors use. So it's not a bug, it's a feature of the process. And we can see how it works in this example. So starting from here, the founders invest $100,000 in their business. The pre-money valuation was 0 because there was no company. Therefore, the post-money valuation was 100,000, and the founders had 100% of that. In the next round, the first round, the seed investor invests $500,000 at a pre-money valuation of $2 million, which makes the post-money valuation 2.5. So the seed investor who puts in 500,000, they get a 20% equity because 500,000 divided by post money of 2.5 gives them 20%. Now the founders are diluted. Their 100% goes down to 80%. But was this bad for them? No, actually this was good because why? Previously they had 100% of a company that was valued at 100,000. So their equity stake was worth 100,000. They now have 80% of a company that is valued at 2.5 million. So their 80% is worth 2 million. And therefore the value of their equity increased dramatically because why? Because they raised another round of funding and were diluted. In the next round, the Series A investor comes in, they invest 1 million at a 4 million pre-money, which is 5 million post-money. This gives the A investor 20%. Now this dilutes both the Series seed investor and the founders. So the Series seed investor who previously had 20% now gives up 4% because why? New investor, Series A got 20%, seed had 20 going in. So seed gives up 20% of 20, which is 4%, leaving them with 16. And founders give up 20% of 80, which is 16%. They're left with 64%. So both seed and founders were diluted, but they're also both better off. Why? Now the founders have 64% of the company that's worth $5 million, which means that their equity stake is worth 3.2 million. Seed investor now has 16% of the company that's worth $5 million, which means that their holding is worth 800,000 instead of the 500,000 they invested. So you can see that this process continues through B, and if there were more stages, and if the same pattern held true where the new investor was paying a higher price than previous investors, the value of everybody's shares goes up in each round, and culminating in an exit where the company is sold at a higher valuation than the last round of funding, and assuming each round of funding had a higher valuation than the previous, everybody makes a very attractive return. So in this case, when the company is ultimately sold at $100 million, we see that the founders' $100,000 is now worth 48 million. The seed investors' $500,000 is now worth 12 million. Series A investor 1 million is worth 15 million, and so on. So everybody wins because of what? Because multi-stage equity funding raised, accompanied by dilution, but normal dilution. And this is just another way of looking at the point that I made earlier, which is that in venture capital portfolios, the winners must pay for the losers. So here I did a very simple model of a venture capital fund, and we don't have to go through this in detail here, but you can see that when we model the real portfolio with a real success rate and taking into account the number of exits, the size of each investment, and required return multiples, that each successful company has to yield, in this case, 31.25x. So it's not just a number pulled out of the air. It's a number that comes from real economics of the real economics of venture capital funds. So we have to calculate exit valuation as the other very important number in the VC method. So how do we do that? We do 5-year revenue forecast, which, good news, we've already done that because that was our task in our financial model. We can take our year 5 revenue, assuming that we're going to exit in year 5. We multiply that number by sector revenue multiples for acquisitions. We do that avoiding outliers, meaning we try to pick a reasonable sector revenue multiple. So we can look at acquisitions in our sector. Let's say we look at acquisitions in our sector and we see there's average revenue multiple for acquisitions is 5x. There's some at 2 or 1.5. There's some at 10 and 15. So in this case, I would look at maybe we can pick a revenue multiple 7 because 5 is the average, but there are some, much higher at 10 or 15. There are some lower, but we're not going to pick lower, case for our comparables. But maybe we can look at the high end of the average. So let's say average is 5 to 7. So we'll pick 7 as our revenue multiple, and later we can negotiate that with investors. But this is the most common method of calculating exit valuation because for most acquisitions of startup companies, they're valued at revenue multiples rather than profit multiples, because oftentimes the company is being acquired very early in its profitability phase after it has already been growing its revenue exponentially over the last, let's say, 3 to 5 years. And this is testing our concept. So if you look at the average valuations at exit in local exchange like MAI, SET, or US IPOs on NASDAQ or New York Stock Exchange, or some representative regional exchanges like ASX and Catalyst, and then looking at trade sales, you can see that this method of dividing exit valuations by 60 to get current valuations actually gives us pretty representative range of current valuations using our comparables method. So there's a very nice symmetry here when we look at the real exit valuation, look at the real market for current valuations, and can see how this all fits together using our different valuation approaches. Oh, so let's not show the answer to question 2 yet. I'm going to go show the spreadsheet now. I'm going to walk through a couple of additional frames in our spreadsheet. So I'm going to share my screen. So this is our financial model that everybody remembers from previous lessons. And today I'm going to focus on a couple of different tabs we haven't seen yet. First, I'll show you the VC method tab. So we have the VC method tab. The VC method tab lets us calculate the venture capital method valuation 2 ways. One way, which is highly recommended, which is the way you should be doing it, is the standard VC method linked to our DCF valuation, which means the VC method linked to DCF uses all the same assumptions as our DCF forecast. So it uses our same, it calculates the exit valuation using the same revenue and cash flow numbers that we're using to do DCF valuation. And this is, I think, one of the strengths of our model because it lets us combine the different valuation methods using all the same assumptions. One thing, don't get fooled when you see cost of capital and probability of success. What that means is this is not the company cost of capital. This is not the same as the discount rate in the DCF valuation. This is the VC's cost of capital. So normally this should be at 25% because you remember we looked at the empirical evidence that venture capital investors, top tier, are delivering 25% to their LPs, which is what we call fund investors, which means that fund investors will have access to those numbers too, so they'll be expecting some similar return. And 10% is probability of success at the exit valuation selected. So the reason I'm using these two numbers, that gives us the 30x multiple. So we can assume that 10% chance of success at this exit valuation will give us our required return. Now, as the exit valuation goes up, the probability of success is going to have to go down because the bigger the exit, the less statistically likely it is to occur. And you can see that this gives us the current value. This is the exit valuation time retention percentage divided by target multiple. So this is what we call VC method valuation, and this is the partial valuation that we're getting, meaning the one that's calculated by the model, which means that this is a good investment from a VC method perspective. If this number was higher than total valuation, this recommendation would change to not invest. So that's how you can use our model to calculate VC method. The reason that we give this second version of VC method, where you can put in all of your own inputs without linking to the DCF output, is in the case where we can use DCF formula because the company has no cash flow. So you can still use the model to do a venture capital method valuation, even if the startup that you're modeling has no positive cash flows. Okay, now moving to this sheet. So this is the sheet where we're going to look at investor ROI, dilution, and calculating our exit valuation. We start at the top of this sheet. So you can see here that the total investment in the startup in this version of the model is 1.2 million, and the company raises 2 subsequent rounds of funding, 5 million at about a 10 million valuation in 2022, and then 10 million at a 50 million valuation in 2024. Now you can see that the year 2 and 3 exit valuations are calculated for you by the model. This goes back to our financials page. So these exit valuations are calculated based on the revenue forecasts here. But in years 4 and 5, you have to input your own exit valuations because we can't do meaningful discounted cash flow forecasts for 1 or 2 years. So when you get to year 4 and 5, you have to estimate the exit valuations. You can do that by looking at the valuations for that round. You can do that by looking at the previous rounds or looking at how much the company is raising and assuming, for example, 20% equity is going out. Now, you notice this row is blue, which means it's an input row. So what this row does is it gives our seed investor a chance to participate, meaning if this row is left blank, the new investment in each of the subsequent funding rounds is modeled to come from new investors, meaning all that happens to the seed investor is they're diluted each time. What this row does, it allows you to model that the seed round investor will participate in future funding rounds. So that means that they will be able to invest again in the future rounds. That's called a follow-on investment. So after they make a 1.2 million investment in round one, they might decide to participate in round two. Normally, companies will have a option to participate in future funding rounds up to their, we call pro rata share. So this investor had this version of the model. The investor has a very high equity percentage of 85%, which is highly unrealistic, but that's just this scenario. So in that case, they would be able to participate 85% of the next round. But that is we call follow-on investment option. Now, you notice here, we're getting a flag because the amount of equity held by the seed investor is very high. So it's going down over time, but it's high. And here we have another flag because founder's equity is way too low. So that's a feature of this model. When the model is giving you output that you should be paying attention to, will be flagged. Now let's go down and look at the investor ROI. So how do we calculate investor ROI? We have to have the exit valuation. And the model allows us to capture exit valuation here. So we can choose either method of calculating exit valuation. We can use the times earnings method or times revenue method. Times earnings method means that we will estimate the exit valuation as a multiple of the company's earnings in the exit year. The times revenue input means that we will estimate the exit valuation as a multiple of the company's revenue in the exit year. And in our model, exit year is 5. So we can see in year 5, this company had 25 million of revenue and 16 million of profit. So, or earnings. So we can determine which we're going to use by adjusting this switch. If this number is 0, we'll use times revenue for the exit multiple. If this number is 1, we'll use times earnings. So we can see right now it's set to 0. We're using a 5 times revenue multiple. So exit year revenue is 25 million. 5 times 25 million gives us 125 million. So our estimate of the company's exit valuation is 125 million using a revenue multiple. If we wanted to do an earnings multiple, we could change this to 1. So you can see that that gives us 128.9 million exit valuation because now we're multiplying 16 by 8 instead of 25 by 5. So, okay, but let's go back. Revenue multiple 5, exit valuation 125 million. Now we can go down to here and see all of the key ROI metrics for this investment. So the initial investment was 1.4 million. Original valuation was 1.4 million. The original investment was 1.2 million. This means that the investor got 84%, which, as I mentioned, is way too high. Then this means that at exit, the seed investor on a fully diluted basis got $42 million, which is about 35 times their original investment. Now you can see that if they were not diluted, they would have got double that. This goes back to our whole calculation about dilution affecting return. If there was 0 dilution, they would have had 88x instead of 34x because they were diluted significantly in this scenario. So they started out with 84%, and by the exit, they only had 33%. So they're actually diluted more than 50%, and you can see how that dramatically reduces their ROI and their ROI. So this is exit multiple of earnings and the investor ROI and sale price of the company. Okay, now I mentioned that the model gives us the ability to participate. So let's say that the investor decided to participate in the second round. So instead of getting diluted by 20% in the second round, let's say the seed investor decided to invest 20% of the second round. So they invest 1 million of the 5 million that's invested in the second round. So this means they will be diluted less. And we can see that if we go down here. So now you see that their ROI has gone down. Because why? Because they invested more money, but they invested at a higher valuation. So let's look at that again. So when the seed investor does not participate in the follow-on round, they get 41 million in return, and they get a 35x ROI. So remember that. Let's say they got 42 million return, and they got 35x ROI. If they participate in the follow-on round, let's say they take their 20% of this round. So now they got 52 million, but they got only 23.6x. So their ROI was reduced significantly. They went from 35x down to 23x. So we're going to ask a question now. It's a poll question. I'm going to ask you to vote. Should the seed investor participate in the follow-on round? So the question is, the seed investor has an option to participate in the follow-on round of funding. Should they participate or not participate? Remember, if they participate, their ROI will go down. Okay, I'm going to stop my screen share for a minute. And we're going to launch our poll question and see what's your answer. Okay, so the vote by a large margin, 74% said they should participate, and 26% said they should not participate. So yeah, this is a very good poll result because I agree with the super majority of the poll. The investor should participate in the follow-on round. Now, let's go back and look at that again, a little more detail. So what makes this question a little bit tricky is when the investor participates in the follow-on round, their ROI goes down. So if we look at this again, their ROI went from, their ROI is 35x with no participation. And then with participation, their ROI goes down to 23x. So they do get, they take a big hit to ROI. And that might make you wonder, why would I want to reduce my ROI by participating in the follow-on round? Because normally, and what we've been talking about over and over so far, is investors want to maximize ROI. And this is generally correct. Investors do want to maximize ROI. But investors don't want to maximize ROI just to maximize ROI. The reason they want to maximize ROI is as a means to maximizing total return. So that's the key to this question, because we can see that ROI went down from 35 to 23x. But what went up was total return. Total return without follow-on is around 42 million. Total return with follow-on is 52 million. So there's an additional, for that 1 million of investment, there's an additional 10 million in total return. Now that's only 10x, and that's why our ROI gets dragged down. But in the end, total return is the key. Like imagine, for example, let's look at a very simple case where this was the only successful investment this fund had. And imagine the fund size was 50 million. So even though they maximized ROI, by not participating, the fund now is less than 1x, meaning investors in the fund lost money. By making this one follow-on investment, now the fund would actually make money. It didn't make a lot of money because it's only 52 million, but it's still, this follow-on investment was the difference between the fund lost money and the fund made money. And this is not an unrealistic concern, because remember, in most venture capital funds, 1, 2, or 3 of your investments are going to drive all the return. So the way I like to think about the follow-on strategy is, if we were to work backwards from our perfect venture capital fund strategy, so let's say we make an initial investment in 30 companies, but only 3 of those companies are going to exit. So what we want to do is we make initial investments in 30 companies, only 3 are going to make sizable exits. So we would want to take as much as possible of our remaining funds and invest in only those 3 companies. And this would maximize our fund return. As soon as we recognized of the 30 we originally invested in, which ones are the 3 that are going to be successful, we could put all of our remaining funds into those 3 companies. Now, in real life, we won't be able to do that because we won't know which ones are going to be successful. But what we can do is to, what I like to do is follow on in as many companies as we can who raise follow-on funding. Because why? It's very likely, it's highly likely that our successful companies are going to be those that raise follow-on funding, because not all who raise follow-on funding will succeed, but pretty much all who don't raise follow-on funding are likely to fail, or if they don't fail, they're going to exit at very low multiples in most cases. So by following on in as many companies as we can that raise follow-on funding, we get as close to our ideal strategy as possible, which is to invest as much of the fund in our winners as we could possibly do. So we allocate as the minimum amount, the minimum percentage of the fund's capital into losers and the maximum amount into winners. In order to do that, we need to do as much follow-on as we can. I'm now going to turn over to you, and I'm going to answer questions in the Q&A and chat. Question 1 in the Q&A is, what is the rationale? What is the rationale to exit at year 5? So our model does a 5-year revenue forecast. So it makes sense in our model to calculate the exit at year 5, because that's the last year that we're modeling the company's revenue. So from a modeling perspective, it makes sense to exit in year 5. From an empirical perspective, actually 5 years from post-seed round funding to M&A exit or trade sale exit is about average. So the mean amount of time between first post-seed funding round and exit for a trade sale is 5 years. For IPO, it's about 7 years. So I think for two purpose, modeling purpose and realism purpose, a 5-year exit horizon is pretty realistic. Now, this can vary by sector. So some types of companies, like some like for example, drug development companies or some agri-tech companies, some medical device companies might take longer to exit. So also depends on what stage of investment are you modeling, but generally 5 years, I think it's a pretty reasonable exit time horizon, both for the startup and for the investor, and it works with the 5-year forecast model. So next question. If there is a company with excess dilution, as an investor, should I invest in the later group, such as Series C, D, E, because of cheaper valuation? Why or why not? So, so I think the question here is looking at a down round. So, because in a round where there's excess dilution, this would be a down round, meaning that the valuation of the company, the share price and therefore valuation of the company would have gone down from the previous round. So is that a good time to invest? You know, I think it's got some pros and pluses and minuses. Like as you mentioned in the question, valuation has gone down, therefore it's going to be cheaper to invest. But I think key thing that you want to look at there is, why did the valuation go down? Why is the company experiencing a down round? There can be, there might be a reasonable explanation for why the company has experienced a down round. And some companies that experience down rounds will recover and get to good exit. But a lot of companies that have down rounds, and especially significant down round, may not get to a significant exit. So I would be a little have to look closely at that particular company and see why they are experiencing that down round before getting excited about the low price, because low price and down round could be a sign that the company is not going to make it, and then I would be very concerned about that. Another problem with investing in a down round, if the company has a down round, the excess dilution is often disproportionately borne by the management team, especially if the investor had anti-dilution. So that can be a problem because now if the management team is heavily diluted by a down round, that can create motivation problems in later rounds. So I would also take a look at, if the company has experienced a down round and you're considering investing, what is the management team's equity going to look like after the down round? And is it going to be too diluted to motivate them in the future funding rounds? So next question was, what are the tools, platform that VCs can use to find comparable exit valuation? So there are some exit valuation information is available in public information sources on internet, online. There are also there are companies that sell this type of data for VCs or investors who are interested to get real data on larger sample of exit valuation. So Crunchbase has information on exit valuation. CB Insights is a company that sells data on VC exits. There are lots of companies that collect and sell this data. Most of the services are pretty expensive. Yeah, and I don't endorse any, or I don't want to mention a lot of brand names or endorse any particular platforms. But if you're interested to find out more about platforms, you can send me an email. Happy to share some recommendations on that. Okay, next question was, how many rounds should a company raise? Is there an optimal number? So Yeah, this I think this reminds me of a question. You know, how long should a man's legs be? And the answer is, you know, long enough to reach the ground. Or, you know, how many words should you have in your song? Is enough word, you know, as many words as you need. So I don't think there is I don't think there's an optimal number of rounds for each company or for any company. The optimal number of rounds is the number of funding rounds that maximizes the exit valuation. You know, so, and that maximizes, actually a little more complicated, because maximizes the exit valuation, but also maximizes the return to the management team. So the challenge that you find in terms of number of, and let's say one issue is number of rounds, but we can also look at it as total amount of money that you raise, because each round you're going to raise money, and typically as the rounds go further, you'll raise bigger and bigger rounds, so more funding. Then the more money you raise, and assuming you invest the money effectively, the higher your exit valuation will become. But also, the more money you raise, the more your shareholders, including the management team, will be diluted. So the smaller share you will get of the ultimate pie. So the optimal number of funding rounds, or the optimal amount of investment rounds, would be the amount of funding or number of rounds that maximize the total return per shareholder. And especially management team is going to be concerned with total return to founders. So I think no right answer to that question, but usually the timing of the exit is also pretty important. So usually you'll decide whether to continue raising more funding or whether to exit, because you'll decide that the increased valuation that you're likely to get from additional funding is not likely to contribute enough additional return to offset the dilution to existing shareholders. So, okay, next question. If we plan to exit in 10 years instead of 5 years, does it mean we need to project revenue for next 10 years? So yeah, if you're really planning to exit in 10 years, you should do 10-year forecast, because then your exit valuation is going to be in year 10, and you need to use that one for the exit to calculate your revenue, assuming it's still revenue based, the exit multiple. You need to get your year 10 revenue to do that calculation. The problem is, and one of the reasons that we typically do 5 years, because as you get 10 years into the future, it's harder and harder to make reasonable assumptions about what is what numbers actually make sense 10 years from now. Like, let's say my revenue forecast for 2026, they're already, pretty remote. But my revenue forecast for 2031, it's going to be very difficult to come up with a number there that leaves everybody feeling satisfied. But if really the strategy requires 10 years, then you should model revenue for 10 years. Now, our model doesn't enable you to do 10 years, so you would have to adjust the model or use a different model that has a longer time horizon. Okay, so so somebody had a question about the VC method. In our VC method in the model, we do total valuation versus partial valuation. So the total valuation is the VC method valuation that we learned about in class today. Partial valuation is the valuation that the model is giving you for your investment. So if the total valuation is a fair VC valuation according to our formula. Partial valuation is what the model is telling you the VC method is giving you based on the inputs that you put in. So therefore, if partial valuation is below total valuation, then you should invest. And if partial valuation is above total valuation, it means that the VC method that's being calculated in the model is different from the one that we learned in class. So next question was, do VCs also require 30x return for seed stage impact startup, or is it something lower? So this is a very good question, because there's actually a broader way to think about this question. I showed the VC's required return comes from the VC's cost of capital. So the VC's cost of capital is determined by the investors in the VC's fund. And therefore that number can be different depending on what is the VC's source of capital. So for example, in this question, impact startup. So let's say I have an impact fund. I'm a venture impact fund. So I make VC investments, but I'm trying to generate two types of return. I'm trying to generate financial return, and I'm trying to generate impact, which usually means some sort of social impact, which means that, for example, we're trying to invest in companies that impact society in some way other than just generating profits or revenue. And I would say that this means that the investors in our fund are requiring that. Whoever invested in the fund should be the one who is determining what is the fund's required return. So if the investors in the fund, meaning the LPs in the fund, if they're targeting a lower financial return and example higher impact return, then the 30x multiple would be different. You could extend this to the most extreme case. Let's say it's a venture philanthropy fund where the investors in the fund don't want financial returns at all. They just want impact return. In that case, 30x would go to 0x. Now, of course, that's venture philanthropy, not venture investment. But this same concept can apply to many different types of LPs, not just impact LPs. For example, in Thailand, we have many corporate DCs, CVCs, and CVCs will in most cases invest in startups for a mixture of financial and strategic return, and therefore their required return from their CVC program might be less than 25% a year. In that case, they might 20 or 25% a year. In that case, they might be willing to accept less than 30x return, financial return per successful company, because they also want to generate strategic return, and they will be willing to trade those two off. Now, I'm not a big fan of that strategy though, because I would argue that we should still get 30x return plus strategic return or plus impact return. Because in that case, our LPs are much better off. Let's say our LPs are getting both the market financial return and the impact or strategic return that they want, instead of us making a trade, instead of us reducing our financial return in order to deliver additional return, why not deliver both for LPs? So deliver market financial return plus whatever return you put on top of that. But your question is definitely correct. LPs can have very different expectations of what's required return, and that'll affect our 30x. So next question is, what percentage of equity should the founders hold at exit and what is investors will do if ROI is less than cost of capital. So, yeah, I think, again, optimum percentage founders hold at exit. Founders would like to hold the highest percentage they can hold at exit while raising enough money to get to the maximum exit. So it's like an optimization problem where raising more money increases exit valuation if you invest that money correctly in growth, but it also reduces your share. So you have to balance those two. But on average, for a successful startup that raises like the 4 rounds of funding that we looked at earlier, founders as a group should expect to have somewhere between 30 and 50% equity. So a good average, probably between around 40% equity, I think is reasonable for founder expectation if they reach a big exit. What do investors do if ROI is less than cost of capital? Is nothing. There's nothing they can do. So if investors' ROI is less than their cost of capital, they just have to eat that. And this is the challenge, and major challenge in VC investment, because there are no guaranteed returns. And if the startups if the portfolio is not delivering the return that is required by investors in that fund, then that fund those fund managers are out of luck, and their investors are also out of luck. So there's no way that venture funds don't have any way to claw back investment or require startups to deliver more than their required return. There are some deal terms that investors can put into investment and shareholder agreements that help them meet required return, like liquidation preferences, which we don't have scope for in our class. But in the end, if everything adds up to VC's return is less than their cost of capital, then VC loses and there's nothing they can do about it. Okay, next question. Should we use the revenue multiple from peer companies in the stock market? So looking at peer publicly traded companies is definitely one way that we can estimate revenue multiple. Ideal case, what we would like to do is we would like to look at comparable transactions, for real M&A transactions. So if there are acquisitions of other startups like ours, so let's say acquisition of comparable startups to ours at known revenue multiples, that's really good information. We can combine that with multiples of publicly traded companies. So usually when we're trying to come up with a very detailed calculation for revenue multiple estimate, we will look at both multiples of publicly traded companies and transaction multiples from M&A. We can also look at segregating companies into higher growth and lower growth companies to get even more granularity on the revenue multiple estimate. But the good thing about publicly traded company revenue multiples is they are readily available. That information will be accurate and available online. So that'll be part of our analysis. Now, ideally, in many cases, our company will be growing at exit, will be growing more quickly than a lot of our peers in the stock market, because those companies will likely be past their hypergrowth stage, which means that the revenue multiples may be lower. So we're going to have to make some adjustments. Okay, next question. What does outliers mean in calculating exit valuation? So outliers mean when we choose comparable, when we try to develop these revenue multiples, we shouldn't pick like extreme cases. Like, for example, when we look at, let's say we look at all of the transactions for companies like ours, all the acquisitions for companies like ours that we can find data for. And we also look at public companies, and we find the average revenue multiple is 5 to 7 times. But we find one company, for example, in the US that was acquired at 100 times revenue because it's just some crazy outlying deal. And probably it was an auction, more than one interested investor. They bid it up like crazy. Or for some other reason, there's irrational exuberance about this company. So there's one company with 100x revenue multiple, but we have a sample of 30 companies that give us average of 5 to 7. So don't pick 100 for your company. Don't use that 100 multiple as the standard because it's a freakish outlier. So it defeats the purpose of using multiples because you're just picking one essentially random case. Okay, is there a benchmark for range of revenue and net income seed stage startups should be targeting to generate in year 5, assuming exit in 5 years? So I wouldn't say there's one single benchmark for revenue and net income. And this depends a lot on the market and also the geographical market that you're in and the product market and the industry and the sector within the industry. So I think no clear range of revenue and net income there. But what I would look at is average M&A acquisition price is starting around 100 million USD, which is 3 billion baht. So what I would look at is, given the revenue multiple, if we're going to be a revenue multiple acquisition or net or earnings multiple acquisition, I would look at what are the multiples in our sector, and then how much revenue or earning do we need to get to a valuation of more than 100 million within 5 years. So I think that's probably the best way to get a reasonable range of revenue and net income estimates for your exit years. Okay, so next question is about can we apply such startup valuation methods to SMEs? So generally, we can't apply, we could use the comparable or discounted cash flow method that we learned in previous class for SMEs. For VC method, it's a little harder because there are very few acquisitions of SMEs. SMEs don't usually get acquired in M&A transactions. If we have an SME that we're planning to take to a listing, so it is possible for SMEs to grow and then list on stock market like Stock Exchange of Thailand, main board, or MAI, in which case then we could do VC method using their exit valuation. If the SME does have a plan to get acquired, then we could use the exact same methods to value the startup, the SME that we use to value startup. Okay, and then the next and last question is, are there any well-known VC funds that we can invest via the stock market? So, yeah, as far as I know, there are no well-known VC funds that you can invest in via the stock market. There may be some VC funds that you can invest in the stock market, but the vast majority of VC funds are not listed on stock exchanges. They're funded by private investors. They're private equity funds, so they raise money from private investors. They don't raise money from the public in stock exchange. They get investment in their funds from either institutional investors or companies or high net worth individuals and sophisticated investors that want to put money into venture capital. So I'm not personally aware of any well-known VC funds that you can invest in via the stock market. There may be some, but definitely not most of the ones, not any of the ones that you've heard of or that I've heard of.